Hi there, welcome to my channel. In this particular video, what we're coming to do is that we're coming to look at how to prepare the financial statements of a firm that uses the single entry system of accounting and or where incomplete records of accounting exists. Alright, so that's what we're coming to do in this particular video. So thank you very much for sticking to my channel. If you are already a subscriber, if you are a first timer, please subscribe to the channel and consider hitting the like button if you like this particular video, and don't forget to share with others so they can also benefit from whatever you are coming to learn in this particular video. Alright, so that is what we have here. So what you are coming to do is actually divided into 4 subsections. So we are looking at preparing the financial statements where there is single entry system and or where incomplete records of accounting exists in the books of accounts. So we are coming to look at that in 4 different sections. Alright, so we are coming to look at where the single entry system exists. Alright, we are coming to dive into that and how to calculate the profits or loss for the period where there is a single entry system. And we are coming to look at, secondly, we are coming to look at the incomplete records, where incomplete records exist in the books. How do we prepare the financial statement to determine our profit or loss for the period, as well as to prepare the statement of financial position or the balance sheet. And then we'll move on to a situation where there are incomplete records and missing figures. All right, how to identify or calculate missing figures that might exist or that might come up during the period. All right, and then we'll also look at a situation where inventory has been stolen or destroyed by fire. All right, so we have a lot to cover in this particular video, so let's dive into business. So the first one we are coming to look at, as I said, is the single entry system. So when we talk about a single entry system, we are talking about a situation where the accounting records are actually not kept in accordance with the double entry system. So as the name implies, this is actually the opposite of the double entry system. All right, so this is the single entry system. That means that the double entry principle of accounting is not being followed, and we've already looked at that in one of my previous videos. All right, so you can check that out where we looked at how to prepare the financial statements in accordance with the double entry system. That is actually the normal way of accounting. But where the business is feels like it's not listed, and so it's not obligated to keep proper books of accounts, then they might use the single entry system. All right, but for tax purposes and for other relevant purposes, the business should be able to determine its profit or loss for the period. And so whether you are using the double entry system or you are using the single entry system, there should be a way of determining your profit for the period so you can know um, where you stand. All right. So the single entry system is where the double entry system is not kept, as I said previously. And in this case, we are talking about um, the statement of profit or loss being prepared by comparing the capital or the equity of the business at the end of the period and subtracting the capital balance or the equity balance at the start of the period and reporting any changes thereof as a profit. All right, so that is what we are talking about. So to determine the profit for the period under the single entry system, you take the capital at the end of the period and you subtract the capital balance at the start of the period, as well as any changes in the capital during the period to determine your profit. So the format is given below. as you can see here. So this is the format for determining the profits for the period under the single entry system. So unlike the double entry system where you need to prepare the various accounts inside their respective ledgers to extract a trial balance and also make some adjustments, year-end adjustments to be able to prepare your financial statements. This one is a single entry system, therefore the format is different. So what you need to do is that you need to know your closing capital at the end of the period. All right. Then what you do is that you subtract or you less the opening capital at the start of the period. Then you will less any additional capital introduced during the period. And then you are going to get a figure. And then you are going to add any drawings during the period. So if every term I am mentioning here has been dealt with previously in my double entry system video, how to prepare the financials. All right, so you can check that out, or how to automate accounting ledgers and then extracting a trial balance. So you can check that video out and then you can understand the terms if you want to. All right, so that is what we do under the single entry system. So let me go over that again. You pick your closing capital balance, you subtract your opening capital balance, and then you're going to less any additional capital introduced, and you're going to add drawings if there is any during the period to get your net profit or loss for the period. So where the capital at the end of the period exceeds the capital at the opening, and then in addition to the capital introduced during the period, then you are going to get a profit which is positive. All right, so that is what we do when we are dealing with single entry system. All right, and you are saying that to be able to calculate the two capital balances here, which is the closing capital balance and the opening capital balance, we make use of what we call statement of affairs. All right, so the statement of affairs um, helps us to calculate the value of our closing capital balance as well as the value of our opening capital balance in the books. And this is similar to the format of a balance sheet. All right, so we take our assets and then we are going to subtract our liabilities. That is the statement of affairs. That is simply the statement of affairs. So it's a statement that takes all your assets and then subtract all your liabilities to get your capital balance. So as you can see here, this is in a columnar form. Usually we do it in a columnar form. So this is our capital at the start of the period, and then we subtracted. We added all the assets, so all our non-current assets, land and buildings, motor vehicles, furniture and fittings, and then you're going to get a total here, which is at the right side, right column here. And then you're going to add all your current liabilities as well. Then you get that. So let me delete this excess space here. Let me also delete this one here. Then you're going to get the total here, and then you can add those together to get your total assets and all that. Sorry, so I'll have that there. And then what you're going to do is that you're going to add all our liabilities and less it from the total assets to get our capital balances. So this will be the capital at the start of the period, and then this one is going to be the capital at the end of the period. All right, so that is how the statement of affairs look like. So as I said, the statement of affairs helps us to calculate the capital balances at the period. For the additional capital introduced is going to be given in the scenario. You will know how much of capital you have introduced in the period, and then also if there are any drawings in cash or in kind, drawings of goods or cash or check, it will also be known in the scenario. So you just add it to this particular figure here, whether it is positive or negative, to get your net profit or loss for the period. So let's look at the illustration here and see how you're going to deal with that. All right, so we have an illustration here to illustrate whatever we are talking about under the single entry system. So we are saying that Rancho started business on January 1st, 2020 with an amount of $250,000 in the bank account. Unfortunately, he did not keep proper books of accounts. He is compelled to submit a calculation of profit or loss for the year ended 31st December 2020 to the Internal Revenue Service, that is IRS. He ascertained that at 31st December 2020, he had inventory valued at cost 98,750, a motor van which had cost $70,000 and had depreciated by 14,000, as you can see there. He also determined his debtors or receivables to be $124,250, expenses prepaid to be $4,250, bank account balance to be $64,100, cash balance of $1,375, trade creditors or trade payables of $25,750, and expenses owing to be $11,750. During the year, he introduced an additional capital of $45,000. He also withdrew cash of $5,000 and check of $16,825. So prepare a statement to show his profit or loss for the year. So this is what we've got. So let's see how we are coming to do that. And as I said, we are going to pick this particular format here. So I can just come here and copy this. Don't worry, I'm going to leave a template of the questions together with the solution, a template of the solution in the description, so you can go download it and then you can follow along. Alright, so we can pick that and then paste here. And what I'm going to do is to delete the stars there, and then I'm going to format this as accounting with 0 decimal places, since all the figures are not in any decimal places. So that is fine. So to get our closing capital, we need to prepare the statement of affairs. To get the opening capital, we need to prepare the statement of affairs. But let's go through the question again and see whether any of the capital balances, sometimes they can give you the capital balance straightforward. Other times too, the capital balance will need to be calculated using the statement of affairs. Alright, so let's see which of the capital balances might have been given in the question. So let's read the question again. Rancho started business on 1st January 2020 with an amount of 250,000 in the bank. So this particular 250,000 here is our opening capital balance. Alright, so if you are confused, once again, go back to my video and then you realize that any amount you use to start your business is actually your capital. The capital is also called your startup asset. Alright, your startup asset. That is your capital. Or other times we call it equity. Alright, so that is the amount you're using to start your business. So the 250,000 here in the bank is actually our opening capital. So I can just come here and put 250,000 there nicely. Alright, so from there we know that the amount to calculate now is the closing capital balance, and we are going to use the statement of affairs. But let's go through again to see if we can input some of the other figures directly into the calculation of the profits for the period. Alright, so let's see. Additional capital introduced. In the second to last sentence here, we've been told that during the year he introduced an additional capital of 45,000. So quickly I can come here and do my 45,000 there. As simple as that. Alright. And we have also been told that he withdrew cash of 5,000 and check of 16,825 dollars during the year. So these are what we call our drawings. So quickly I can come here and put and add those two figures together. So I have 5,000 plus 16,825. I hope you get whatever we are doing here. All right, so that's what we have there. Then um the next thing we have to calculate now, or the last thing you have to calculate now, is the closing capital balance, which we are going to less this to get a figure here, of which you are going to less this, and then we are going to get a figure here as well, and then we are going to add the drawings to get our net profit or loss for the period. So let's copy the statement of affairs here. So I'm going to copy that format there, and I'm going to paste it. So let's see if we need to insert additional space there. So let me just double click inside one of the cells, and then let me increase my space here a little. So let me insert a couple of rows there. I think that is okay. Then I can go back and select one of them, just one of them. It's the same thing, just that one is at the start of the period whilst the other one is at the end, but the format is the same for both of them. So I can just come here and delete all of that, and then also format the area as accounting with 0 decimal places there. All right, so I think that is fine. So what are our assets? All right, we are going to look at our assets and see which of the assets here are actually in our scenario. All right, so he ascertained that at 31st December 2020, he had inventory valued at 98,750. So quickly I'll come here and write 98,750. So that's how you're going to do it for all of them, as simple as that. So all you need to do is to get the format off head, all right? And even this is logical. You have started. Okay, so let's finish first, and then I can teach you a trick on how to remember this without necessarily memorizing the format in your head. All right, so let's finish it, and then I'll give you a hint on how to do that. And then he also has a motor van which had cost 70,000. So what is our motor van? We have motor vehicles here. I can put the value here at 70,000. All right, and we have been told that it had depreciated by 14,000, which we can see there. So the motor van had depreciation amounting to 14,000. So quickly, I need to come here, and I'm going to delete this and also delete that, and then I can cut this and paste it on the first column, and I'm going to have less. So we know that we always subtract depreciation from the cost of the asset to get the carrying amount of the asset. All right, so I'll just come here and write my 14,000 there, which should be formatted as an accounting figure with 0 decimal places. So I can come to the second column and input my carrying amount there, or the net book value of my assets, which is the motor van, the 56,000. All right, so that is it. Then we continue. So that is it for the motor van. All right, so we take the cost of the asset and then we subtract depreciation to get the actual carrying amount of the asset. And then quickly I can delete this excess um, row there. All right, then we move on. He also determined his debtors. The debtors are also called receivables. All right, so the debtors of 124,250. So what do I do? I'll come to my receivables and write 124,250 there. Okay, and he also determined expenses prepaid to be 4,250. All right, so let me come here and then insert that, and then I can say expenses prepaid. All right, expenses prepaid is their assets. All right, expenses that have been prepaid are actually assets because they are receivables. You can actually receive them in case um the service has not been rendered onto you. You can receive the money back, so it's an asset to you, and the amount involved is 4,250. All right, and then we have bank. Let's go to the scenario and see. Then we have bank balance of 64,100 there. So I'll come here and write my 64,100 right there. Cash balance. Okay. So this is named bank and cash. So I'll come here, input my equal sign, and then I can add my cash balance of 1375. Let me see if that is correct. So cash balance is 1375 as you can see here. So I'll just press my enter, and that gives me the total cash and bank. And then I can come here and write my alt equals, and I'll select everything here and press my that. All right, and then I can get my total as alt equals, and then I'm going to select the entire space here, and this is my total assets for the period. All right, and then quickly let me insert my borders there. All right, so that is the total asset. Now what we are coming to do is to subtract our total liabilities. All right, so let's see what the liabilities are. So it has trade creditors of 25,750, which is also our trade payables, and also expenses owing of 11,750. So I can change this to expenses. All right, expenses owings, and the amount is 11,750, and then my payables amount is 25,750. All right, sorry, so I can just copy this and rather paste it on the first column, and then I'm going to delete that so that the total will come here. So I have my alt equals, and then holding my shift, I can select the second one, the shift plus the up arrow key to select the second value, and then I can press enter, and that will give me my total liabilities figure there. And so my capital balance at the end of the period is going to be the total asset value here minus the total liabilities here, and that will give me 311,225. So quickly I'll come here and link that particular figure there, 11,225. So with that, we can now calculate our figures. So I'll come here, do my alt equals to, sorry. So what we'll do is that to be able to be adding, we are going to put these figures in as negatives. All right, so also put this one as a negative, so that when I add, it's going to have a negative effect on the sum. So I'll have alt equals, and that's going to sum those two figures for me right there. I'll hit enter. I'll also come here and hit alt equals and sum. Sorry. So alt equals, and then hitting and holding my shift key, I can use my up arrow key to select the second figure and hit enter. And this gives me the value of 16,225. I can now add the drawings figure, which is alt equals to add those two figures together, and this gives me a profit of 38,050. All right, so let's see. All right, so that is the profit for the period for us. So I'll just insert my top and bottom border there. So that is the profit. So this is how we calculate the profit when there is a single entry accounting system. All right, this is how we calculate our profit whenever there is a single entry accounting system. So for as a recap, you start with your closing cash capital balance, which is calculated using the statement of affairs, and the statement of affairs is just your a list of all your assets added together, and then subtracting a list of all your liabilities added together, and that will give you your capital balance, which is the difference between the total assets and the total liabilities, either at the start of the period or at the end of the period. So in case the scenario had given us figures for, in case the scenario didn't give us this opening figure directly, we would have uh, using the columnar format here, we would have used it to calculate the capital at the start of the period as well. All right. So that is it for calculating the profits using the single entry system. So after calculating the closing capital balance, you less your opening capital balance, you less any additional capital introduced during the year, and then you add drawings if there is any during the year. So that is it. Now we go to the second part of the video. As I said, there are going to be 4 parts. Now this is the second one. We are talking about incomplete records. All right, incomplete records. Now, incomplete records is a situation where the information available is inadequate for the preparation of the financial statements. That means that a number of workings must be undertaken in order to obtain sufficient relevant figures for the preparation of the accounts. All right, so we need to do some workings in order to derive certain relevant figures that are sufficient enough to be able to help us prepare the financial statements. All right, so that is what we do under incomplete records. So, what are those standard workings that are needed? One, we are going to prepare the statement of affairs to determine the opening capital balance. So when we talk about the statement of affairs, I hope you know exactly what we're talking about. Secondly, we are going to prepare what we call control accounts to obtain our receivables and payables figures. And these receivables and payables figures are actually derived from our credit sales and credit purchases respectively. All right, and so this is going to help us to obtain our total sales and our total purchases figures in the financial statements for the period. All right, so when we get to the calculations, you are going to understand that. So the control accounts is a kind of a summary account that summarizes all our credit purchases and our credit sales for a particular period. That is what control accounts do. All right, so we will get there and then you understand. Then thirdly, we are going to prepare expenses and revenue accounts to ascertain the amounts of these expenses to transfer expenses and revenues to transfer to the statement of profit or loss. Now, there is a reason for this. The reason is that is because you are using the accrual basis of accounting. All right, so some amounts related to expenses and revenues might not relate to the current period. That is, they might be relating to periods other than the current period, and so we need to take those amounts off. And so we are going to use a system of this particular formats here to determine our revenues and expenses to transfer to the statement of profit or loss. I'm going to explain that in a jiffy. And then finally, we are going to prepare any other accounts or workings necessary for the final accounts to be prepared. For example, cash book to determine the closing cash balance, etc., etc. So that is what we have there. So pay critical attention to this particular part that I'm coming to explain here. It is it's not very tricky, but some find it quite difficult to understand. So I need you to pay very critical attention to this particular part of the video. All right. So this is what usually confuses students in the exam room. They don't know where to place which item. All right. Now, as I said in the point 3, you are saying that you are going to prepare expenses and revenue accounts to ascertain the amounts to transfer to the statement of profit or loss for the period. All right. Now, this is the account we use to prepare that for the expenses. All right. And this is the account we use for the revenues. All right. So, this is how the account works. Expenses can be prepaid or owing. And if you have watched my previous video on how to prepare the financial statements of a sole trader, you should be familiar with what I mean by prepaid expenses and accrued expenses or expenses owing. All right. So there are two main categories of expenses. You can have expenses prepaid, that is paid in advance, or expenses owing. Now, when expenses are paid in advance, it means that the benefits have not been received in the current period. So the amount that we have paid is relating to the next period, not the current period in which the money was received. This is accrual accounting. Accrual accounting says that you recognize revenue or expenses when it is incurred, or when the revenue is earned, or when the expenses is incurred, and not when cash is received. So when it comes to prepayments, we are receiving the cash, but the expense has not been incurred. So whatever cash you receive, you are going to transfer it to the next period. So when you come to preparing the expenses account in this particular scenario, when there is a prepaid expense at the beginning of the period, we are going to bring it as a balance brought down at the debit side of the expenses account. Now, expenses accounts have a debit balance. All right, they usually have a debit balance. Now, don't be confused with the owings and then these owings here for now. So assume that they do not exist. So let me just highlight those for you to understand whatever I'm explaining here. Assume for now that the items in the yellow here are not existing. All right, it is only, we are dealing with only this and only this. All right, so expenses have debit balances. All right, and that means that anything that increases our expenses for the period is going to be debited. Okay, and anything that decreases our expenses is going to be credited, because expenses have a debit balance in their accounts. All right, you can check out my previous video and understand how we prepare accounts for expenses, and then you can understand more. So that is what we have there. And so this prepaid here, opening prepaid, is an amount that has been taken from the previous period, which means that the amount, the expense, has been prepaid in the previous period. So it is going to be added to the current year's expenses figure here. That is why you are seeing it at the debit side. All right, that's why you are seeing it at the debit side here. And then if there is any payment for expenses, any expenses that has been paid for, we are going to have that also added to the opening prepayment here to get our total expenses for the period. All right, and then if there is any prepayment in the current period which is going to be transferred to the next period, is going to occur here as a balance carried down. All right, we have it here, balance carried down here. All right, and that will be brought down here. So we'll have balance brought down to the next period. So as I said, this balance brought down here has been carried from the previous period. And so this particular balance carried down, which does not relate to the current period, but the amount has been received in the current period, but the expense has not been incurred in the current period, is going to be transferred into the period in which the expense will be incurred. Therefore, we are going to bring down that particular balance there, as we are seeing here. All right. So that is how the expenses account works for prepayments, and the opposite is true for owings. All right, the opposite is true for owings. So when there is expenses prepaid brought forward into the current period, we will debit it. When there is expenses owing brought forward from the previous period, they are going to credit it here. All right, and any closing balance of owings of expenses will be um, at the opposite side, which is the debit side here. All right, so whenever the opening balance is at the debit side here, as we have for prepayments, the closing balance will be on the opposite side here. Whenever you have the closing balance from the previous period as opening balance for the current period at the credit side, it means any balance at the end of the period, the current period will be on the opposite side, which is the debit side here. All right, so that is what we have. So this balance carried down will also be brought down here as balance brought down. All right, so that is what we've got here. All right, so just as you assume that, so these things cannot occur in the same account at the same time. So what we do is that you can only have expenses prepaid in one account at a time. You cannot have one expense being prepaid and being owed at the same time. All right, so that is what we have there. When we get to the scenario, you will understand even more. All right, so that is just by the way. So let me just remove the selection there. Then the revenue account, when you come to the revenue accounts, the opposite happens. The opposite happens when it comes to revenue accounts. All right. So instead of debiting your opening prepaid for revenue, you are going to debit rather the opening owings. All right. And then if there is any closing owings, it's going to be credited. Then, if there is any opening prepaid balance, you are going to debit it. You are going to credit it, sorry. And then, if there is any closing balance of prepayments, you are going to debit it as well. All right. So that is how it works. Opening balance of revenue owings is debited, and closing balance of revenue owings is credited. Opening balance of revenue prepaid is credited, and the closing balance of revenue prepaid is debited. You can check out my previous video if you haven't yet to understand what I mean by prepayments and owings or accruals here. All right, so you can just check that out. Now, to make the scenario even more clearer, let us look at the illustration here, and then we can see what we have. So the Gen Z analyst, a sole proprietor, does not keep proper books of accounts. From your investigations, you discovered that he kept a small notebook into which he recorded all cash receipts and payments for the year ended 31st March 2022. Alright, so this information is found in his small notebook. Alright, so it has receipts and payments accounts here. So we had receipts at the debit side here. The receipt and payment account is also the cash book. All right, it records all receipts and payments for the period, and receipts are at the debit side of the account, and the payments are at the credit side of the account, as you can see here. All right, so it has all the receipts and then the payments here. Okay, so we have rent and rates, postage and telephone, electricity, purchases, trade creditors, insurance, drawings, sundry expenses, shop fittings, cash in hand as the payment for the period, and then also as sales as cash from sales, and then trade debtors as well, forming part of the receipts for the period. All right. Then these assets and liabilities at the end of the year were as follows. All right, so we have 31st March 2020. 1. All right, so these are the list of assets as at the end of the previous period, and this is the list of the assets at the current period. All right, so that is what we have here. So the assets include kiosk shop, shop fittings, inventory in trade, trade debtors, trade creditors, rent and rates prepaid, electricity owings. All right, so that is what we have there. Then it has a further information here. Discounts allowed and discounts received for the year were $1,000 and $800 respectively. Cost of goods returned to creditors amounted to $1,200. Cost of goods returned by debtors amounted to $1,500. Required. You are to prepare the statement of profit or loss for the year ended 31st March 2022 and a statement of financial position as at that date. So that is what we have here as a scenario. It's a simple one, but it's going to get ugly. So tighten your seatbelt and let's start what we have here. So to do that, as I have already explained in how to prepare the financial statements in Microsoft Excel, whenever you are to prepare financial statements, you always draw a pro forma financial statement. All right, you always draw a pro forma financial statement as you have here. So this is not the time for me to be explaining the format of the financial statements. All right, we have dealt with that in several of my videos, so you can check those videos out if you are new to whatever we are doing here. All right. Then we have the statement of financial position as at 31st December 2022. Now, I just want to comment on this that the statement of profit or loss is for the year, whilst the statement of financial position or the balance sheet is as at a particular date. All right. So this means that the statement of profit or loss reports every transaction that occurred from the beginning to the end of the year. That is why it is for the entire year. Whilst the statement of financial position reports the position of the business at the date you are preparing the account. So in this particular case, at 31st March 2022. All right, so just take note of that. All right, so after preparing your pro forma financial statement, don't worry, I'm going to leave this in the comments for you to download and follow along. So after preparing your pro forma financial statement, what you need to do is to quickly go to your workings sheet. So to make life easy, let's put our workings here. So I'll just come here and put workings. All right. Now from the standard workings, we know that you need to prepare your statement of affairs. So when it comes to the statement of affairs, and we are to prepare the statement of affairs, so let's see. So when it comes to the statement of affairs, we are going to prepare it for the beginning figures here. So these figures here. All right. As I said, the statement of affairs are your list of assets less your list of liabilities. All right. So that is all we are doing. That is all we are doing. So I'm going to leave you with a challenge. I want you to prepare the statement of affairs at the beginning of the period. All right, that is 2021, 31st March 2021, or that is the same as 1st April 2022. All right, so prepare the statement of affairs as at 1st April 2022. Now, let me give you a hint. When you prepare the statement of affairs correctly, you should be getting your non-current assets or your fixed assets to be equal to 251,000. All right, and that should be calculated from these two figures here. All right, then your current assets should equal 79,750, and those can also be found right here among these particular items because the two fixed asset items are out. All right, so that's what you should get, and then your current liabilities should be equal to 4,500. All right, your current liabilities figure should be equal to 4,500. So I'll leave you with that challenge. Calculate the statement of affairs to determine the capital balance at the start of the period. So as at 31st, so I just want to make 31st March. 31st March 2021. All right, and the amount you should be getting, so the capital at start should be equal to 326,250. All right, so this is the figure you should get when you prepare your statement of affairs correctly. All right, so I'll leave that to you as a challenge. All right, sure. So when you're able to calculate this and you're able to get a figure, don't forget to leave a comment in the comment section so I can acknowledge you as such. All right, so let me just insert something here. Good. So that is it for the statement of affairs. And secondly, you have to prepare what you call control accounts. All right, so when you come to the statement of profit or loss here, when you come to the statement of profit or loss, you will see sales, and then I put W2 here. That means workings 2. All right, so the workings 1 is the statement of affairs. The workings 2 is our sales. So that means that I'm now coming to determine our sales figure. All right, so what is our sales figure? Our sales figure is going to be determined using the control accounts, and the specific control accounts you are going to look at is the debtors or the receivables control account. All right, so I'm going to have two receivables, so that is sales. Workings 2 is sales, and I'm going to determine that using my receivables control account. All right, so the control accounts, receivables control account, as I said, is what it does is that it takes all the your debtors, it summarizes all the debtors of the firm into one account. So it's a summary account. All right, it's a summary account. Let me just center that across selection. Okay, and then I'm going to insert a bottom border there, as well as this vertical border. So I'm creating my account, right? So that is it. And then we are also going to do same for the third working, which is payables control account. So since we have receivables control account, we also have payables control account. So I'll paste that here, and then I'm going to change this figure to payables. All right there. And this is my workings 3 payables, sorry, purchases. All right, so this is how the control account works. The receivables account or the debtors account has a debit balance. All right, which means that at the end of the period you should be having the balance brought down at the debit side here. That means that is what we mean by an account having a debit balance. At the end of the period, when you balance off the account, the balance brought down should be at the debit side of the account. That is the account having a debit balance, and it is having a credit balance when the opposite is true, when the balance brought down is at the credit side of the account. All right, so the receivables account has a debit balance, whilst the payables account or the creditors control account, all right, creditors control account has a credit balance. So it means that anything that increases the receivables account will be debited, and any item or any transaction that reduces your receivables account is going to be credited in the receivables control account. All right. The same applies to our payables control account. Anything that increases our payables is going to be credited, and anything that reduces our creditors figure is going to be debited. All right. So it's the opposite of the two. All right. So let's go to our scenario and see what we have there. So we come here. Now we are going to determine the opening balances of our receivables and our payables. All right, what are our opening balances? Those opening balances here can be found on the amounts at 31st March 2021. These are the opening balances of all the accounts we are having in our books. All right, this means that now 31st March 2021 is the same as 1st April 2022. So this is the end of the previous year. The starting point is going to be the first of the following month, which is April. So 1st April 2022 is the same as 31st March 2021. All right, it's just like 31st December 2023 is almost in accounting. We say is the same as 1st January 2024 in accounting. All right, that is acceptable in accounting. So that is what we have there. And so all the figures you are seeing here are actually opening balances. That is at 1st April 2022. All right, 1st April 2022. So this is our trade debtors here, 7,000. All right, and this is our trade creditors here. And as I said, trade debtors is the same as trade receivables or receivables, and trade creditors is the same as trade payables. All right, so receivables and payables are actually the most common terms we use. All right, so don't be confused with the terms. They are the same. Debtors are also known as receivables, whilst creditors are also known as payables. All right, or suppliers. So we know that the balance for our receivables. So I'm coming here and then I'm going to have balance brought down. So this is our opening balance. As I said, the balance is a debit balance for the receivables control account, whilst the balance for the payables control account is a credit balance. So the balance brought down will be at the opposite side of the payables when it comes to the payables account. So balance brought down right there. All right. Then I'll input my dollar figure here, my dollar sign there. I'll also come here and input my dollar sign here as well. And then I can copy that and come and paste here and also paste here. All right. And then I can also have everything there nicely set up for me. Okay, so that is it. Now the balance for my receivables, as we have already determined from the question, is 7,000. So I'll come here and write my 7,000, or I can just come here and link that particular amount, the 7,000, right there. Okay, and then quickly I can also come here. I'm going to prepare this simultaneously so you can understand the differences between the receivables control accounts and the payables control accounts. At the end of the lesson, you should be able to prepare a receivables control account and a payables control account as well, in addition to the main objective of the video. All right, so this is actually something that you may want to learn. All right, so we have that, and then I can also link my payables control account figure right there from here, which is 4,000. All right, so those are our balances brought downs, and this confirms that the receivables control account has a debit balance, and this one. So where these figures are negatives, all right, where these figures are negatives in the opening balance, they would have been, this one would have been at the opposite side of the account. All right, this will be at the opposite side of the account here if it had been a negative figure, which is rare. All right, that means we have our creditors, we have overpaid our creditors, and this one also means that our debtors have overpaid us, which is actually a rare situation in businesses. All right, so that's just a tip for you. So we have that. And as I said, anything that increases our receivables is going to be debited in the receivables control account. And anything that reduces our receivables is going to be credited in the receivables control account. So let's come here. So that is this particular figure here is just for us to determine our opening and closing balances. All right. Every other information you need is either in the notes or the additional information here or on the face of the receipt and payment account right here. All right. Now we have sales here. We have trade debtors here. All right. Now this is the cash book. All right. These trade debtors here, it means we have paid. Our debtors have paid us, and so we have received it as cash in our books. All right. The receipts here are actually inflows. All right, they are amounts I've received, whereas the payments here are actually outflows. So the amount here, trade debtors, labeled as trade debtors, 32,500 here, is amount you have received from our trade debtors, from our debtors. All right, that means that our debtors figure or our receivables figure has reduced by that amount. All right, so I'll come here and say cash, or you can also say receipts and payments. As I said, the receipt and payment account we are having here is also known as our cash book. All right, that is why you come here and then you write cash there. All right, so we have that, and I'm going to link that particular amount there, which is actually a payment received from our debtors, 32,500, and that has reduced our receivables figure. All right, I hope you understand it. Then you are going to ask yourself, is there any other thing that is going to reduce or increase our debtors figure? All right, if we don't have anything like that, remember everything in the receipt and payments account here is relating to cash. All right, these are actually cash payments and cash receipts. That's why I'm saying that this is also known as a cash book. All right, so don't be swayed by the receipt and payments account here. It's actually a cash book. All right, so from the look of things, we don't have any other item that is going to affect our debtors figure. So let's go to the additional information and see what we have there. Now we have been told that discounts allowed. All right, when is discount allowed? When discount allowed is the amount the discount you give to your debtors when they purchase from you. All right, so discount allowed reduces our debtors figure. So let's say that a debtor purchases an amount of 2,000 worth of goods from you, and then you offer a discount of $100. It means that in effect, the amount that will be receivable is going to be the difference between the two figures. So the total sales you made, and then you're going to subtract the discount allowed the customer. And in effect, this is the amount that the customer is actually owing you, or this is the receivable amount. All right. So that is the same logic that is applying here. So discount allowed affects our receivables and is going to reduce the receivables figure. So you will come here and have discount allowed. All right, and the amount involved there is 1,000. All right, so let me actually format the whole of this part here as accounting with 0 decimal places, and also do the same for this one. So I'll format that as accounting with 0 decimal places. Okay, so we have the discount allowed there, and then let's go to our, so let's finish the receivables control account first, and then we go to the payables control account, and then let's see the other information there. So that is it. So the 800 relates to discount received, which will be treated similarly in the payables control account. All right. Then we have cost of goods returned to creditors, 1,200. cost of goods returned by debtors. So cost of goods returned by debtors, this is what we call in accounting return inwards. So we have return inwards. Now, what the return inwards does is that it also reduces our debtors figure. All right, it works the same way as the discount allowed. It also reduces our discount. So you sold goods of 2,000 to your customer, and the customer says that okay, they actually wanted only 1,500, and so they have returned the extra 500 on it. This 500 here is what we are calling returned inwards. All right, returned inwards, and this can also be due to maybe some of the goods are faulty. All right, so that can also warrant some of the goods to be returned to you. So what we are saying is that this in effect is reducing the amount of receivables. All right, it's reducing the amount of receivables. So that is what we have here. Now remember this particular account here, if we are trying to determine the amount of receivables in the period, remember this is incomplete records. Alright, the records are incomplete, so we are picking figures from different sources to determine our debtors, total debtors for the period that we can include in our financial statements. Alright, so that's exactly what we are doing. So I'll come here and write return inwards, and the amount was 1,500. All right, so that is what we have there. And now I don't think we have any other information, so let me just delete this. I don't think we have any other information. So what we are coming to do is that we have trade debtors, we had the opening balance here, and we have the closing balance. So this closing balance becomes our balance carried down for the period. All right, so and that is the balance brought down into the next period. So what do? We will come here. This is how we treat it. You will come here and write balance. Remember, the receivables account has a debit balance, which means the balance brought down should be at the debit side. So the balance carried down, the balance brought down should have been carried down, and that is done at the opposite side of the account. So I'll come here and write balance carried down, and the amount involved is 13,000. Okay, and this amount should have been brought down here as balance brought down of 13,000. All right, so that is what we have there. Now that we have everything here, we are going to balance off the account. All right, so as we know from the previous lesson, balancing of an account is where we determine these balance brought downs and balance carried downs. But in this case, the balance brought downs and the carried downs have been given to us already. So what is going to be our balancing figure? So that's what I'm saying, that the receivables control account is to help us determine the total receivables for the period, or the total debtors for the period. And that is also equal to our credit sales. So we will come here and then you have credit sales. The credit sales is the same as our receivables for the period. All right, the amount of goods you have sold on credit is the same as the amount you are going to be receiving from your debtors. All right, so that is going to be the difference. So let me actually put that here as brackets difference. All right, so diff there for you. And we are going to now balance of the account. How do you balance of the account? We are going to add the totals together. So I'll have this 48,000. Now I've put the credit sales here because this total is obviously greater than this total. All right, so this is going to be the total for both sides. We've learned how to balance off accounts already, so this is not the time for me to be um, teaching that all over again. So you can refer to my previous video for that tutorial. So after determining the total balances for both sides, we have determined that this is greater than this one, so and this is less. So I'll come here, the balance is now the total minus the total for the lower side, which is only 7,000 there, so I'll subtract that, and this is 41,000. All right, that is 41,000. And what that means is that our sales, okay, will now be equal to the credit sales, okay, which you have determined using the receivables control account, added to the cash sales, which is found within our receipts and payment account. You see, we have sales here. This sales is our cash sales. So the total sales for the period is equal to the credit sales determined using the receivables control account added to the cash sales within our cash book or the receipts and payment account. So I'll select that and hit enter. So this is our total sales for the period. So quickly I can just come here and insert this particular total here, enter. I hope you've gotten it. So that is why I said that this is uh, our workings tool. All right. Now quickly, we are going to use the same logic to prepare the payables control account. We have already inserted the balance. So let's see what other items are going to come there. So let's come to our payables, our cash book, and from there we see trade creditors. So this is the amount you have paid to our trade creditors, and that has reduced our payables for the period. So that is 25,500. So what do? I'll come here. It's going to be at the opposite side of the account, and then I'll have my cash there, and the amount involved is 25,500 right there. All right. And just as we have discount allowed, we have discount received, which is also from our creditors to us, so it has reduced our creditors balance. So we have discount received of uh, 800, if I'm correct. So I think it's 800. And since we have returned inwards, I guess we have returned outwards as well. So cost of goods returned to creditors. So in this case, the Gen Z analyst, went to buy goods from suppliers and returned some of the goods. So that means that the amount he's owing the suppliers has reduced by this amount, 1,200. So and that is what we call return outwards. You are correct. So we have return outwards. So I'm actually taking my time so you can understand whatever I am doing here, and that amount is 1,200. All right. Then, just as we did here, I think that is all for the information in our question. So the next thing we need to insert is the balance for the period. So the balance at the end of the period is balance carried down, and that can be found on this particular schedule here. So let me just insert that figure equals. So the balance carried down for our trade creditors or our trade payables is actually 5,500. So I'll link that up. I hope you understand whatever we are doing here. Alright, so now that we have done that, we can balance off this account as well. So quickly, I know that this particular the debit side is going to be more than the credit side. So I'll just have alt equals and add that together, come here and link that also. So this becomes the total for both sides. Let me actually, the total for both sides, all right, that is fine. And the difference is now equal to the total minus the total for the lower side, which is only 4,000 there. So this is 29,000, and this is what we call credit purchases. You got that right. So just as we have credit sales, we also have our credit purchases here. All right, and that is actually the difference. So let me put that here. Difference. All right, and we can now bring down the amount here as balance brought down, and that is equal to this particular balance carried down here of 5,500. All right, so let me just link that up there. Great. So let me insert my double bottom border here. All right, so just like that, we are done with the receivables and payables control accounts. So we have determined our credit purchases, and just as we did for the sales, we are going to do it for the purchases. So I have my equals here, and I know that my purchases will now be equal to the credit purchases added to my cash purchases, which is in the cash book or the receipt and payment account in this particular case, and that can be found here at the credit side, 21,000. All right. So our purchases is actually 50,000. Our total purchases is actually equal to 50,000 right there. So I'll come here and then insert my purchases, and that is going to also be at the, let me put it at the first column here. There is a reason why I'm putting it there. You understand when we are dealing with the other figures. So right now what we're doing is that we are doing all the necessary calculations that we need, all the standard workings that we looked at. We are going to look at each of them, and then after that we can insert the direct figures here. Alright, so that is what we are doing. This is the difficult part of it, so let's finish with it first, and then the easier ones can be done easily. Alright, then our workings 4 is going to be rent and rate. As I said, we are going to prepare expenses and revenue accounts. So any expense account usually is the expense account. Revenue accounts are rare, all right, unless you are dealing with non-trading organizations where you need to prepare accounts for subscriptions. That's when you need that particular account. But most of the time in these particular exam scenarios, we usually deal with the rent and rates, electricity, telephone and postage and all that. Those are the amounts that we pay in advance or owe. All right. So rent and rates account. So our rent and rates there. Then that one too is going to, this is an expense account. So what I can do is I can just go to the standard workings here and copy this particular format here. So I can just copy that, and I can come down here and paste it right here. Alright, the only thing is that it is a bit wide, but it's okay, we'll manage. So what is happening here? Let's go to the question and see whether our rent and rate has been prepaid or is owing. Alright, so rent and rate prepaid. So quickly I'll come here to the format, and I'm going to delete all the owings here. Sorry, so this owings here will be deleted. This one here will also be deleted. Alright, so we have that, and then I can now cut this and paste here. Alright, sorry, what's happened? And paste it right there, and then I can also cut this and paste here. Okay, so that is just by the way. So this is now the format for us. Now balance brought down, which is the opening prepaid balance. What's the opening balance? As I said, the opening balance is always this particular first column here, because this is the date. Alright, so the opening balance of our rent and rate prepaid is 1250. So I'll come here and have my 1250 there. Alright, so let me actually format these areas as accounting figures with 0 decimal places. Okay, so I have that. Now to prevent flipping back and forth, I can be looking at I'll leave the question in the video description so that you can follow along, so I don't need to be going up and down like that. All right, so that is it. And then our closing balance can also be determined. Our closing prepaid balance can also be determined. So this is the prepaid balance. This is our closing balance of 1750. So quickly I'll come here and insert my closing balance here, 1750 right there. Okay, then let's check the cash book and see if there is any payment for rent and rates. So I'll just change this to rent and rates account. All right, rent and rates account there. So I'll come here And then my cash book, let me check if they made any payment for my cash book. All right, so we have rent and rate payment here, and then I'll hit enter there. So why am I putting it at the um, debit side of the account? Because you have paid for rent and rate, you have paid for this particular expense. And if whenever you pay for an expense, expenses have a debit balance. All right, so that means that our expenses for rent and rate has increased. All right, that means the expense has been increased, so we are going to debit it. That's why it is being debited here. All right, that's just by the way. If you want to understand that, as I said, you have to watch my previous video to understand everything even better. So cancel. So that is it. Those are all the items we have within our scenario. So what do we have? We already have the balance already. So quickly I can come here and say balance brought down, and that will be equal to this particular balance carried down here. And this balance brought down is the amount. This balance brought down you are seeing here are the amounts you are going to use in our statement of financial position. Take note of that. The balances, these are the balance acts, so we are going to use them in the statement of financial position. All right, so that's just by the way. And then we can now balance of the account. So I know that this part is definitely going to be the uh, the greater part, so I'm going to add that. I have my total here, and then I can link the total here, copy that and paste. Okay, and then the balancing figure, which is now going to be transferred into the statement of profit or loss. All right, that is the balancing figure. So I'll come here and then I'll have my total here and subtract this particular balance carried down there, and is going to give me the amount that we are going to recognize in the statement of profit or loss as rent and rates. So quickly I can come here into my statement of profit or loss, and you have rent and rates workings 4. I can just come to the second column here, and I'm going to link that particular amount there of 11,500. All right, so I've linked the amounts there. Okay, then quickly we are going to do the same for another account, which is electricity, because you also have electricity. This is rent and rates prepaid, and then electricity owings. All right, so you check through the question. Any information that is relating to prepayments and owings need to be treated the same way we are doing here. All right, you check through the questions and see if there are any trade debtors and any trade creditors, or trade receivables and trade payables, and then you are going to treat it the same way we are doing here. All right, that is how this incomplete system of accounting works. So we have here workings 5, and I'm going to have electricity. All right, and with that I'm still going to, this has been owing. Okay, electricity is an expense, but in this case it has been owing. So quickly I'll go to this particular account, so I can just copy the rent and rate account and edit it to save time. So I'll just come here, copy this. All right, I'll copy that and come here, and I'm going to paste it here. And this is electricity account, so I'll double click and I'll have my electricity. All right, and these are opening, prepaid, and all that. So what is going to happen is that I'm going to delete. This has not been prepaid, rather it has been owings. All right, it's an owing. So this is what I want to do. All right, so let me just delete the entire content here. let me just delete the entire contents there and go to my owings account. But actually, we can actually do it right here. Okay, so without the format, you can still do it. So let's come here. What is happening is that you are going to have your balance brought down, your owings balance brought down. All right, and the amount is found within the list here. So what is our balance brought down from the previous period? Owings is 500 right there. So I'll insert that. All right, and our balance carried down will be here. So I'll have my balance carried down, which is the balance for the current period. So I'll just go there and link that up, which is 300 right there. All right, and then we also paid for electricity. So I'll come here and write cash. We also paid for electricity in our cash book. So I'll go to my cash book and link that particular amount we paid for electricity, 4,200 right there. All right, so that is the amount we have here. Then the balancing figure now goes to our profit or loss account. So profit or loss right there. Okay, so this will be equal to okay, so let's calculate the total first. So alt equals total, and then I'm going to link the total here as well. And the difference now goes to profit or loss, and that's going to be 4,500 minus the 500 here, and that will give me 4,000. So this is the amount which is going to be transferred. All right, it's going to be transferred to the statement of profit or loss. So I can just come here. Where is my electricity? I can come here and link that particular amount, which is 4,000 right here. All right, right there, 4,000. So just like that, we are getting closer. So before the last one we are left with is depreciation for the fixed assets or the non-current assets. All right, so let's calculate those at once. So with the depreciation, there are so I have my workings 6, and then I'll have depreciation. And the first one that we are going to do is the kiosk shop. All right, so what is the depreciation of our kiosk shop? How do we calculate depreciation? Depreciation is the fall in value of the of an asset over the period. All right, so when the fall in the value of the assets as a result of usage, as a result of passage of time, is what we call depreciation. So what you do is that we are going to calculate the cost of the asset. We are going to add any additions to the assets, and then you are going to calculate the depreciation. All right. Or another way to know the fall of the value of the assets is to actually take the value of the asset at the start of the period. All right, because in this particular scenario, you have not been given any depreciation rates to apply to the assets. So how do we calculate the depreciation of the assets for the period? Is by taking the value of the assets at the end of the period and subtracting the value of the assets at the beginning of the period. Or is the other way around, we take the value of the assets at the beginning of the period and subtract its ending value to get the depreciation amount. All right, that is what we do. So what do we have? We are going to have balance brought down of the assets, and that is going to be equal to the amounts we have here. So this is 225 for my kiosk there, and then let's go to the payment and see if you have bought any kiosks during the year. We have not bought any kiosks, which means that the only two values relating to kiosks are this the beginning amount and then the ending amount. So the difference between those two figures is going to give us the depreciation for the period. All right. So this is the balance brought down, and then I also have balance carried down, which is the amount at the end of the period. Balance carried down, which is equal to this particular value here of 215,000 right there, and then I can find the difference, and the difference becomes our depreciation. So the balance brought down minus the balance carried down gives us the depreciation right there. And let me insert this thing here, and this is what we call depreciation. Now this is not how depreciation is usually calculated. We usually apply a certain percentage on the balance carried down. All right, the balance carried down at the end of the period, and that is going to give us the depreciation for the period. Okay, so we apply a percentage to the balance at the beginning of the period to get the balance at the end of the period. But in this case, this information is incomplete. That's why we are calling it incomplete. That is why we don't have any information for the depreciation information. All right, so that is for the kiosks. So right from there, I can come here and link that particular figure there. So my depreciation for the kiosks is going to be equal to 10,000 right here. All right, now we have shop fittings. So shop fittings. For the shop fittings, we are still going to have the balance. So we have balance brought down. Sorry. So we have the balance brought down here, and the amount is going to be equal to, just as we did for the kiosks, is going to be this 26,000 there from the previous period. And what we do is that we will check again in the receipt and payment and see if you have paid for any shop fitting. So this shop fitting here you are seeing in the payment side means that we have bought additional shop fittings during the year. Okay, so that is cash. So we have bought additional shop fittings. So that is going to increase the value of the shop fittings in the period. So I'll come here and write addition. You can write put cash there, or you can put addition there. All right, and that is equal to 10,000. Let me format everything here as an accounting with 0 decimal places. So that is 10,000. All right, so this becomes the total assets for the period. So I'll just have alt equals there, add those together, and then let me insert a border to differentiate that from. So this is the total figure for the period. And at the end of the period, which is balance, at the end of the period, which is our balance carried down, the value of our shop fittings is equal to, let's go to the information there. So at the end of the period, the shop fittings was 33,500. So I'll link that now. And then the difference between this figure now and this figure now will give us depreciation. Now you can present this in two ways. All right, you can present it in two ways. You can, sorry, you can actually bring the balance carried down here, and then the difference between this particular figure and the balance carried down becomes depreciation, which will be here. So this is what I mean. You will actually have the 36,000 there, and then you will have your depreciation of 2,500 there, and at the addition of those two will give you the balance carried down for the period. Sorry, the difference between the two will give you the balance carried down for the period. All right, so as I said, this will be equal to 36,000 minus 2,500. and that will give you 33,500. So that's an alternative way of presenting it. Same way applies here. You can bring your depreciation at the balance carried down side and bring the balance carried down here. I think that will be a better way of presenting it. But I've done this already, so that is just by the way. So this is how we determine the depreciation in this particular scenario. Now, when it comes to incomplete records, the treatment of the items depend on the scenario that has been given in the question. All right. So whatever you treatment you give to the item depends on the particular information you have available. All right. So you might not have all questions following this particular format of depreciation. All right. But this is what we have in this particular scenario, and that's what we are using. All right. So that is just by the way. So we have our depreciation also calculated for the shop fitting. So I can just go there and insert that figure here as well. So equals, that is 2,500. Remember, all the balance carried downs which has also been brought down are going to be used again in the statement of financial position. So don't forget about that. Now that we have done with the calculations, let's now go and insert the figures that are now direct. So that is going to actually take just a bit of time. So we have sales figure here, and then the next thing is to less the sales returns. So what is our sales returns? We have that in right there as 1,000 sales returns. So cost of goods returned by debtors, that is our sales return. So 1,500 right there. Okay, so let me format the entire section here. Just format the entire section. Sorry. So let me format the entire section as accounting figure with 0 decimal places. Okay, so that is our net sales, and then the difference between the sales and then the sales returns is going to give me my net sales. So I'll have my sales here minus the sales returns, and this gives me my net sales of 101,500. Let me bold in that, and then let me insert bottom border there. All right, so that is our net sales for the period. All right, then we'll have our opening inventory. What is our opening inventory? The opening inventory can be found in this particular list here. So we have inventory in trade, 60,000 at the beginning of the period. So that is 60,000. So I'll have my 60,000 here. And we are going to add purchases, which we have determined already. And from the purchases, we are going to less our purchases returns, which is the cost of goods returned to creditors here, 1,200, right? So I have my 1,200 there, and that is going to give me a net purchases figure here. So let me insert a border here, come here, and that is going to be giving me the net purchases of the purchases here minus the less purchases returns right there. So actually this is supposed to be add. Okay, so let me just leave that for now. So we have 48,800, and that is our net purchases, and that will be added to the opening inventory of the period. So at the beginning of the period, we had this amount of inventory in the business. Then we had this amount of purchases during the period. So we are going to add that to the opening inventory, and that is going to give us what we call cost of goods available for sale. All right, so this is will be equal to this plus this. So opening inventory plus the net purchases is going to give us the cost of goods available for sale. All right, and then we are going to subtract closing inventory. What is our closing inventory? This is our opening inventory, so this is our closing inventory, 65,500, as you can see here. So I'll come here and have my 65,500 right there, and that is going to give me the net effect is going to give me what we call cost of goods sold, or COGS. I'm sure you might have come across this particular COGS in your studies in accounting. So this is how we determine our costs. All right, it is the cost of goods available for sale minus the closing stock. So cost of goods available for sale minus closing stock, and that gives me my cost of goods sold, or what you can also call cost of sales. All right, cost of sales. So now, with the cost of goods sold, we are going to subtract it from our net sales, and that is going to give us our gross profit for the period. So I'll take my net sales and subtract my cost of goods sold, and that will give me my gross profit for the period. All right, and with the gross profit gotten, we are going to add other income, and the other income in our scenario here is discounts received. Discount received is added to our gross profit in the financial statement. It's an other income to the business. So we are going to add that to the financial statement, to the gross profit in the financial statement. And that is given as 800. All right. So the total gross income is actually these two figures. It's actually these two figures added together, and that will be giving me 59,000 right there. All right, so that is it for the first part of the statement of financial performance. Then we have our operating expenses here. The next one is postage and telephone. So I can just come here and insert my postage and telephone here, 2,600. The next one is discount allowed, which we knew to be 1,000 from the additional information here. So discount allowed is 1,000, whilst discount received is 800. So discount allowed is an expense to the business, whilst discount received is an income to the business. That is the interpretation. All right. So I have my 1,000 there. Then we also have sundry expenses. So what are our sundry expenses? 3,400 there. We have insurance. These are all expenses, all right, operating expenses. So insurance of 4,000 right there. Then we also have our depreciation figure, which is going to be added together. So I'll have my alt equals here and add those two together, 12,500 as depreciation. So this is all our expenses or our operating expenses for the period. I hope that is correct. All right, so we have dealt with rent and rates, postage and telephone, electricity. Purchases, we have dealt with it in our purchases, in calculating our purchases. Trade creditors has been dealt with. Insurance, drawings is not an expense. All right, we are going to treat that under the equity or capital column. All right, then we have sundry expenses, shop fitting, you have dealt with them. Cash in hand is going to be dealt with later. All right, so these two figures are actually statement of financial position figures, all right, as well as this one, which you have already dealt with. Okay, and then when you come to the credit side here, this cash in hand is actually going to be dealt with, and we have dealt with this already. We have dealt with this already. Okay, so that is it for our operating expenses. So I can add everything together here, and that will give me my total operating expenses of 39,000. So I can just cut this and paste here, and then insert my border here. And so the difference between the total income of 59,000 and our total expenses for the period is going to give us our net profit, or the profit for the year, of 20,000. So let me come here and insert my top and double bottom borders here. So that is the total net sale and net profit for the period. So just like that, we have determined our profit for the period for the Gen Z analyst. All right, so that is it. Now let's go to the second part of the financial statement, which is the statement of financial position. All right. All right, so we have here, when it comes to the non-current assets, we will actually have three columns. So we have costs, So let me put the $sign in brackets. We'll have the depreciation. You have depreciation, so apostrophe n right there, and then we'll also have net book value, which is shortened as NBV. So I'll put that in brackets there. All right, so this is how we do it when you come here. So what is the costs of our shop, our kiosk and all that? So the cost is actually found as this is the cost of the assets. That is the beginning values of the assets. Okay, that is the cost. So for kiosk, it's going to be this 225,000 there. So 225,000 is the cost of our kiosk here. So I can come here and link that particular value there. And then when it comes to the shop fittings, it is the balance plus the addition. Okay, so this is the 36,000 right here. Those are the cost of our assets. And then the depreciation, we have calculated them already. For my shop, my kiosk shop, it is this 10,000 there. And then for my shop fittings, it is this 2,500 right there. Okay, so let me just correct that. All right, so that is it. And then the net book value is the difference between these two figures. That is the balance carried down. If you like, you can just come here and pick the balance carried downs, or you can just redo the calculation here. So that is going to be the cost minus the depreciation. All right, and then I can copy this particular formula down right there. And then I can add those two figures together. That will give me my total. I can copy this across here. All right, and then let me insert bottom border for this, and then also a bottom border for those two. Right, so we are going to deal with only the net book value here. These ones are not going to be utilized. All right, they only assisted us in calculating this particular value here. All right, so we move on. What is our inventory figure? The inventory figure is the closing inventory figure we have among the list of assets and liabilities. So we come here, and the inventory figure is going to be the 65,500. As I said, it is the let me see if we have that there. Okay, so we don't have it here. All right, so the balance is actually this particular balance here. That's the inventory figure. That's the ending inventory figure there, closing inventory. All right, 65,500. So I'll link that up. And then my trade receivables. My trade receivables is also going to be the ending balance here of 13,000 right there, which can also be found within the sales receivables control figure, which is the balance carried down 13,000 here, as you can see it there. All right, then my rent and rates prepaid is also found on the rent and rate account. That is the balance carried down, or the balance brought down, one of them, because the amounts are the same. So I just come here and pick the balance carried down right there, and that is my rent and rate figure. I can also get that figure from the list here, 1750 there. All right, so what we are saying is that prepaid expenses are actually assets, because as I said, they are receivable amounts, and therefore they are assets. All right, and then our cash in hand is going to be equal to this 15,300 cash in hand here. This is the opening balance, so this is the closing balance. This opening balance here, 11,500, will be used within the statement of affairs. All right, the opening balance will be used in the statement of affairs only. So that is it. So I'll click OK. So this is our total current assets. I'll come here and add those together. All right, and so my total asset is going to be equal to let me actually add those two together. So it's going to be the total non-current assets plus my total assets, and this gives me my total assets for the period. All right, as at 31st March 2022. Then we have financed by capital. So what is our capital figure? We determined that using the statement of affairs, and as I said, when you calculate it correctly, you should be getting this particular amount here, 326,250. So I'll link that up right there. And then we are going to add the profit for the year, which we calculated to be 20,000. And then we are going to, let me add those two together and insert bottom border here. Okay. Then we are going to less drawings for the period. So what are our drawings? Our drawings can be found within the cash book. This means that the drawings were actually cash drawings. So I'll have that right there, and then picking this total and then lessen my drawings, I'll get my total equity here. All right, so that's the total equity right there. Then we have our current liabilities. What are our current liabilities? We have trade payables that can be found within the the payables control account here as balance carried down 5,500 right there. Okay, and then we also have electricity owing. Electricity owing is this balance carried down 300 right here, there. Okay, so our total of our current liability is 5,800. When we add that to the total equity right there, then we are going to get our total equity and liabilities figure right here. So I'll just come here and then I'll insert my top and bottom border. So just like that, we have finished preparing the financial statements of a single the Gen Z analyst who keeps incomplete records of accounts. All right, who keeps incomplete records of accounts. So that is it for the incomplete records. So I think I'll have to end it here because the video has been longer than I expected. I actually took my time to explain most of the things that we are to explain. So I think that has chopped in too much into our time. So I'll end it here and then I'm going to continue in the next episode. Thank you very much for your time in this particular video. I hope you enjoyed the video. In the next video, we are coming to continue from where we left off. So we are going to look at how to deal with incomplete records and missing figures. Alright, so a situation where an item relating to cash receipts and payments may be missing. How do we find or calculate that particular missing figure? And then finally, we are going to look at how to calculate inventory stolen or destroyed by fire accidentally. When that happens, even if you are keeping complete set of books, when this happens, you are going to still lose some of your goods. So how do we find the value of that particular good? So that's what we're going to look at in the next episode. So thank you very much. I hope to see you in the next video.